Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hysan Development Company Limited annual report. Hysan's business operations are centered around its investment portfolio in Lee Gardens, Causeway Bay. The company provides various services to its tenants through approximately 5.5 million square feet of retail, office, and residential space. This includes creating a sustainable ecosystem by partnering with tenants. The company has identified two key areas for growth: the refinement and expansion of its core business in Lee Gardens, as well as investing in new pillars that will diversify its portfolio. These pillars are expected to deliver a more balanced and diversified range of services and businesses, further solidifying Hysan's presence in Hong Kong's commercial heart. The list of businesses and services provided by Hysan includes retail space, office space, residential space, sustainable ecosystem development, investment management. These services are expected to be refined and expanded through the company's medium to long-term strategy, with a focus on creating a more balanced and diversified portfolio. The stock price of Hysan Development Company Limited has increased significantly over the past year, with a total shareholder return of 76.77% as of March 2, 2026. Several key news events and company developments have contributed to this increase. One major factor driving the surge in stock price is the strong full-year 2025 results announced by Hysan Development. The company reported an eightfold increase in net profit to HK $315 million, with underlying profit rising 28.3% to HK $0.51 billion. This positive performance has boosted investor sentiment. Another significant catalyst for the increase is the Lee Gardens redevelopment and expansion project. The imminent completion of Lee Garden 8, a major 1 million SQFT expansion, is expected to boost Hysan's retail and office leasable portfolio by about 30% in 2026. This expansion will drive recurring rental revenue and tenant sales. Hysan Development has also launched a 5-year capital recycling program aimed at realizing HK$1 billion through the sale of non-core assets. By the end of 2025, HK $0.1 billion had been realized from the sale of Bamboo Grove units, with an additional HK $0.6 billion contracted for 2026. In addition to these developments, several financial institutions have raised their target prices for Hysan Development and maintained buy ratings on the stock. The company has also declared a second interim ordinary dividend of HKD 0.81 per share for the financial year ended December 31, 2025, which will be paid on March 27, 2026. Overall, these factors have contributed to Hysan Development's significant increase in stock price over the past year, with a total shareholder return of 76.77% as of March 2, 2026. Hysan Development Company Limited market capitalization of $21 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Hysan Development Company Limited holds a significant advantage in their industry. Hysan Development Company Limited trades at a lower price-to-book ratio of 0.32 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 32% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.35%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by increased foot traffic in retail portfolios, improved local sentiment, and the introduction of new brands to Lee Gardens precinct. Additionally, curated content and experiences have engaged different generations, while office portfolio occupancy rates have improved. Strong retail performance, solid office occupancy improvement, and continued occupancy improvement at Bamboo Grove have also contributed to revenue growth. Furthermore, the ramp-up of Lee Gardens Shanghai has contributed to overall revenue growth, with increased retail leasing occupancy and steady leasing activity. Diversification of tenant mix, strong marketing initiatives, and the return of inbound tourism have also driven revenue growth. Improved market sentiment in Hong Kong's luxury residential sector and strategic divestment of non-core assets have further boosted revenue. On the other hand, revenue decline factors include negative rental reversions in the office sector, corresponding impact of major enhancement works for Lee Gardens rejuvenation project, and increased interest cost and loan drawdowns related to asset enhancement projects. Macroeconomic challenges from new supply in the area, structural shifts in consumer behavior, and decrease in office turnover have also contributed to revenue decline. The net income of a company saw a significant increase from HK $35 million in 2024 to HK $315 million in 2025. This upward trend suggests that the company's profitability has improved over this period. However, a closer look at the underlying profit and recurring underlying profit reveals a different story. These metrics actually decreased from HK $956 million in 2024 to HK $510 million in 2025 for underlying profit, and from HK $956 million in 2024 to HK $918 million in 2025 for recurring underlying profit. This apparent contradiction can be attributed to the fact that net income is a reported figure, which may not accurately reflect the company's true profitability. The decrease in underlying and recurring underlying profits suggests that the increase in net income was likely due to non-recurring or one-time factors rather than sustained improvements in the business. The company's financial performance indicates a strong ability to generate cash from its operations. According to the provided summary, the company has generated significant amounts of cash from its operations in 2025. Specifically, it is reported that cash generated from operations was HK $531 million on page 18, and operating cash flow for 2025 was $3,831 million on page 25. These figures clearly demonstrate a positive trend in the company's operating cash flow, indicating that it has sufficient funds to meet its financial obligations. The consistency of this data across multiple pages further reinforces the conclusion that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, net borrowings increased by HK $953 million on page 18, indicating a rise in debt. However, this trend is contradicted by page 25, which shows that the debt level decreased from HK $872 million to HK $903 million. A closer look at the total gross debt reveals an increase from HK $26,717 million to HK $28,737 million on page 19. Nevertheless, the breakdown of specific debts on page 20 does not provide a clear indication of whether there is an overall increase or decrease in debt levels. Regarding interest expenses, page 18 mentions that interest and taxation decreased from 1,006 to 1,129, implying a reduction in interest payments. The effective interest rate also decreased to 3.7% at year-end 2025 from 4.3% at year-end 2024 on page 20, further supporting this trend. In conclusion, while the debt level appears to have increased initially, it later decreased significantly. Meanwhile, interest expenses and the effective interest rate have both decreased over the past year. The company's performance across various segments and regions has been mixed. On the positive side, the retail segment has shown strong growth, achieving a 2.6% increase in revenue and HK $507 million in segment revenue. The Lee Gardens Shanghai investment property has also contributed to overall revenue growth since 2024, delivering a new stream of recurring earnings. In contrast, the office segment has underperformed, with only a 0.1% growth rate and negative rental reversions. The residential segment has performed well, with a significant increase in assets and $401 million in segment profit. However, the retail segment's performance on page 27 was weaker than other segments, with lower turnover and revenue. The company's asset base has also seen an increase across all segments, with the retail segment experiencing the largest growth of plus 1,173. Overall, while some segments have performed well, others require improvement to drive further growth. Management is optimistic about the company's outlook, citing several key strategies that will drive growth. The primary focus is on creating a community that promotes connection and inclusivity, while also prioritizing sustainable economic practices. This is expected to be bolstered by the recovery of tourism numbers and improved consumer sentiment in 2026. To sustain further growth, management plans to continue investing in flagship Masons, refreshing retail atmospheres, and introducing new brands. Additionally, they are prioritizing the rejuvenation of Lee Gardens and constructing new developments to elevate the shopping experience. This will be complemented by immersive marketing experiences that combine popular trends with traditional cultural elements. The company is also well positioned to capture increasing demand for flexible workspace solutions in the Greater Bay Area flex business. Furthermore, management is optimistic about the growth prospects of this segment, citing its ability to differentiate itself through premium product offerings in the luxury residential market. Overall, these strategies position the company for continued success and growth. The company has made several strategic moves through acquisitions and divestitures to expand its business portfolio. In terms of acquisitions, the company has invested in various projects and ventures that align with its growth strategy. Notably, it acquired a 25% stake in a joint venture for the Taquawan residential project. Additionally, investments were made in several other initiatives, including the Taquawan residential project, Shanghai Investment Property Grand Gateway 66, Greater Bay Area Flex, and Medical and Health New Frontier Group. On the divestiture side, the company has taken steps to optimize its financial structure by redeeming certain securities. Specifically, it tendered and fully redeemed 4.1% subordinated guaranteed perpetual capital securities worth US $750 million. Furthermore, a portion of 4.85% senior perpetual capital securities was repurchased for US $5 million. These strategic moves demonstrate the company's commitment to growth and financial discipline, positioning it for future success in its respective markets. The company's financial activities have been transparent in their annual reports. On page 18 of the report, it is explicitly mentioned that the company has engaged in two significant financial activities. Firstly, they have paid dividends to their shareholders, indicating a commitment to rewarding investors for their loyalty and trust. Furthermore, on the same page 18, it is also stated that the company has bought back shares from the market. This move suggests that the company is confident in its future prospects and wants to reduce the number of outstanding shares, thereby increasing the value of each share held by existing shareholders. That concludes the financial summary for Hysan Development Company Limited. Feel free to comment below, and I will be happy to answer them when possible.